To me, the $64,000 question over the next 12 months as we watch the price of gold is it possible that what we have watched in the expansion of the gold to oil ratio from, call it, 20 to 80 has been essentially policymakers standing aside and no longer you managing the price of gold with the intention of restructuring the system in this way, which is to say, the only thing they have left that they can do, right? They tried Doge to cut spending. It didn't work. They tried to beat up China. It didn't work. They tried to, sort of go to war on the border of Russia. It didn't work. All they have left is to devalue the debt somehow. And really the easiest way is let gold go, revalue it, and then buy down the debt.
The critical economic question for the next year is whether policymakers have quietly ceased managing the price of gold, allowing the gold to oil ratio to expand unchecked. This shift from 20 to nearly 80 suggests a deliberate strategy to restructure the financial system by allowing the metal to rise naturally rather than suppressing it. If true, this indicates that the standing aside phase is the prelude to a monetary reset in which gold is finally used to resolve the solvency crisis. LukeGromen, founder of FFTT, Forest for the Trees, identifies this as the final option for a cornered administration. Previous attempts to fix the fiscal imbalance, including Doge-styled spending cuts, trade wars with China, and geopolitical pressure on Russia, have largely failed to stem the bleeding. With no practical tools left to manage the deficit, the only remaining lever is to devalue the debt itself. The most logical path is to allow a massive revaluation of gold reserves, utilizing the increased equity to buy down sovereign liabilities and reset the ledger. Now we present the clips from LukeGromen's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The price of gold has been capped for a long time by the expansion. Capped is too strong. The price of oil has been managed. The price of gold. Did I say well? The price of gold has been managed over time by the expansion of unallocated gold, credit gold, etc. And we know that has happened. We don't know the extent to it. On the charts that the gold to oil ratio has been relatively stable under the petrodollar system at around, 15 to 10 to 25, 15 to $25 a barrels per ounce, right? It's sometimes higher, sometimes lower, but it's spent most of the time in that range. To me, the $64,000 question over the next 12 months as we watch the price of gold is it possible that what we have watched in the expansion of the gold to oil ratio from, call it, 20 to 80 has been essentially policymakers standing aside and no longer you managing the price of gold with the intention of restructuring the system in this way, which is to say, the only thing they have left that they can do, right? They tried Doge to cut spending. It didn't work. They tried to beat up China. It didn't work. They tried to, sort of go to war on the border of Russia. It didn't work. All they have left is to devalue the debt somehow. And really the easiest way is let gold go, revalue it, and then buy down the debt. So I think I think you raise a great point, which is the gold equities can do the gold or oil being in a 62 to $80 range, relatively low volatility. Those are good return on capital spots for oil E&P plays. And you're still, the decline rate on the installed shale base being what it is, right, is because those wells decline much faster. That implies a pretty healthy rate of business activity for your equipment providers and a steady rate of ROIC, a good ROIC for those names, and they're pretty depressed, right? XOP's done, very little over the last, I'm going from memory, 3, 4, 5 years. So, that makes sense to me. Like that's a world where the oil E&P names can be fine. Oil doesn't have to go too far because it'll break the treasury market over 85. And, then you have a release valve where gold to oil ratio keeps rising for a time and the E&P names do pretty well. I think the miners have only just started repricing the possibility that 80 plus is a new normal for the foreseeable future. I think those shares would be way. If you came to me and said, Luke, if where would GDX be if the world knew for certain that the new normal is a gold to oil ratio of
Mm.
100 to 200 barrels per ounce? And
Mm.
I think GDX wouldn't be 100. I think GDX would probably be 300 or
Yeah.
200. And that's one of these sort of big $64,000 questions. I think the new normal for gold to oil ratio probably is over the next couple of years 100 to 200 barrels an ounce, maybe more, until again we can get gold to a level that sets up the revaluation, the buy down of debt, the restructuring of the system, and then go. And that's, I think, the inflation that you talked about, Patrick, of that's when I think sort of the Main Street inflate. Because what you're really talking about is creating money, creating new money with no new debt offset through gold to buy down debt that is very, very inflationary.
The era of managing gold prices through unallocated credit appears to be ending, as policymakers seemingly stand aside to allow a massive structural shift. The gold-to-oil ratio, historically stable between 15 and 25 barrels per ounce, is expanding rapidly and may be targeting a new normal of 100 to 200 barrels per ounce. This divergence suggests a deliberate strategy to restructure the financial system, with spending cuts and geopolitical pressure failing to curb deficits. The only remaining option is to let gold soar to devalue sovereign debt. This release valve allows the system to remain solvent without immediately crashing the bond market. This scenario creates a massive repricing opportunity for miners and a stable environment for energy stocks. With oil likely capped between $60 and $80 to protect treasuries, producers enjoy stable returns, while gold miners GDX are poised to explode as they have not yet priced in this expanded ratio. If the market accepts this new paradigm, mining equities could triple in value. Ultimately, this leads to a revaluation event where money is created without a new debt offset, triggering significant Main Street inflation as the final cost of the reset. Let's get back to the interview.
You can see, in World War II, we ended, I think, at 110% debt to GDP, and they got it down to 55% within 5 years. And U.S. real rates bottomed at negative 13%. And the Fed was capping yields at, front end at 0.3%, 10-year at 2.5%. You had capital controls in place, et cetera. But you were down to 55% by 1951. And then you could do the Fed Treasury Accord, which reseparated the Fed and Treasury. And you still kind of continue that same playbook. So by late 60s, early 70s, you were down to 25-30% of debt to GDP. And so at that point, when inflation picks up, you can really let bond yields go wherever you need them to go because there's no threat of rendering insolvent the federal government. They could pay whatever interest they needed to pay. And oh, by the way, the entitlements were basically nothing still at that point because of demographics, what have you. And like you said, fast forward to today, we're at 120%. It's down from 130% at the peak. To get it from 130% to 120% took the U.S. running, call it 15% nominal GDP growth with 8 to 10% CPI, and the Fed buying bonds at essentially zero. And when you look at it that way, it just gives you a brief glimpse. If that's what it took for us going from 130 to 120, what would it take? It would take another 5-6 years of those types of numbers to get it probably from 120 down to something more sustainable, 70-80%. And like you said, that would create a whole bunch of second derivative problems, obviously political stability problems, which we already have in probably greater amount than we've had in at least 60 years and maybe 100 years. And the other issue that is generally left off by lots of people to talk about it is the entitlements are dollar denominated obligations only in sort of the strict sense. What they're really, particularly Medicare, Medicaid, they don't owe dollars. They owe hips, knees, pharmaceuticals, doctor's time, inflation. It's essentially a hard currency. The entitlement portion of the U.S. Off balance sheet liabilities coming on balance sheet are very similar to Weimar Germany when they owed the money in gold Reichsmarks. So the more they printed, the more the obligation went up. And the more they print in the U.S., the more the cost of healthcare goes up, the more the cost of, and so, I think there's some things they're doing around fraud that they're trying to reduce that before they sort of print, which is, I think, smart. I think that's probably has something to do with some of why they've been trying to crack down on some of the fraudulent related activity that you're seeing in Medicare, Medicaid. It's pretty widespread from what I hear. But at the end of the day, the more you print, the more the cost of healthcare is going to go up, which means the more you need to print. It's a very precarious scenario that is very different than where we were in the 70s. And to me, ultimately, when you boil it all down, it goes back to, like you said, Patrick, you're basically in a print or die scenario where to maintain the nominal solvency of the system, you're going to have to inflate. And I think, that all ties back to that capital rotation event, which is, everybody knows that everybody knows, right? Once you hit a common knowledge point, it is starting to become obvious that I think to everybody in markets, the market is telling us with the capital rotation event that this is the only way out. And therefore I need to own some gold. I need to own some silver and in particular gold, with all those different, that great chart you guys have of the 12 different sectors and factors all entering bear markets, like 1930, 1972, 2002. Like they're like, buy gold, go to the beach, come back in 10 years and figure out what you want to do. Well, to me, one of the reasons fundamentally I was getting nervous before I saw that technical breakdown was exactly that. The fact that every other cycle, it wasn't even close. Bitcoin massively outperformed gold, right? And the rate of change, right? It was whatever, the rate of change of peak of how many ounces of gold, right? So, whatever, it went from zero point 0.1 ounce to 11 ounces to, or to zero point 0.1 ounce to 1 ounce to 10 ounces to 30 ounce, whatever it was, right? And then 30 ounces or 35 ounces to 36 ounces. And you'd never gone that span of time where you hadn't completely destroyed gold, right? Like if the mainstream narrative was holding, you wouldn't have seen Bitcoin fighting at 35, 36, 34 ounces of gold. You'd have seen it blow through there like a hot knife through butter and be at 55 or 60 ounces of, maybe even, 45, 50, 60 ounces of gold, but it hadn't done that. And so that to me it was a splinter in my brain, right? When you see these things that go, I know the narrative, I know what's happening. They're not mixing. You've been around markets enough, both of you. Those are the kind of things where you just go, okay. You make a mental note, you wait to see for resolution. The resolution was it broke on the downside, of course, on the technicals. I'm out. So when I look at, I think you guys have a great chart that shows the rounding top, right, of Bitcoin. I think you're kind of referring to that of the Bitcoin priced in gold, and that chart is rounding.
The Doom Dome.
And yes, the
The
dome.
Doom Dome.
I am partial to that dome. When I look at that, I could see that happening. I'm also I could also see it not happening. I don't, I think it's entirely possible. I don't have a strong view on that. I'm open to sort of both being the case. Some of that I think depends on events and what have you, but I could absolutely see that playing out. Yeah, I'd answer your question too, I guess, before on the equity side. Going back, I never answered that, Kevin, of with equities not having not breaking down as much against sort of PPI, et cetera. Equities in the U.S., U.S. is whatever 65% of global equity market cap. So, and in the U.S. equity, it's a matter of national security for stocks to go up because they're the key marginal driver to tax receipts, to consumer spending. The number we came out, we looked at the IRS data back in 2014 and we would keep track of it. And if you look, so U.S. consumer spending is, call it 2/3 of GDP. And that's personal consumption expenditures, or PCE. The net capital gains plus taxable IRA distributions alone are about 200% of the annual growth in PCE. In other words, if stocks don't rise, consumer spending mathematically cannot grow in the United States, which means GDP likely cannot grow. And so there is a political dynamic within the technicals that you're discussing that may be manifesting in terms of the reticence or the stubbornness of stocks not to fall as you might otherwise expect in this capital rotation event. And my view, based on the fundamentals, is I would be open as a technician to that not happening this time as much as you might think, and that instead the release valve might be gold going, equities falling more in gold, or gold going up more in equities, simply because policy of the last 20 years has allowed equities to become the key marginal driver. The U.S. government, the Treasury, by virtue of this, equities back the Treasury market. So they can't let equities go down a ton and stay down for very long before it's going to blow up the Treasury market, because they simply won't have the tax receipts to pay the interest and the entitlements. And so I think it's a really important point to raise in light of that second part of your prior question, Kevin, because I think I'm very open to that being the case based on the fundamentals that it wouldn't invalidate the capital rotation event. It just might be an idiosyncratic feature because equity market cap in the U.S. is so big and it's so important to preventing the collapse of the Treasury market and the system more broadly.
A critical but often overlooked dynamic is that the U.S. stock market has effectively become a matter of national security. Because capital gains and asset distributions account for a massive share of consumer spending and tax receipts, the government cannot afford a prolonged equity crash without triggering a collapse in the Treasury market. This structural dependency implies that stocks may be artificially supported to keep tax revenues flowing, preventing them from falling in nominal terms even as the real economy deteriorates. However, this support mechanism forces systemic pressure to find another release valve. If equities are propped up to protect the bond market, the capital rotation will likely manifest as a stock collapse when priced in gold. The market is signaling that the only way to navigate this decade-long reset is to step away from complex sector bets and hold the one asset that has historically survived every currency crisis. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.